HCL Technologies' prima facie tepid show in Q4 FY22 masks the strong performance of its service business. Weaker than expected performance of its products and platform business not only impacted revenue but also pulled down margins. No fireworks are expected from this business in the near term as reflected in the company's overall revenue guidance for FY23. The robust order book, commentary on pipeline and strong hiring point to continuation of the strength in demand. Supply-side pressures and future investments could keep margins range-bound. HCL Tech has a strategy in place to address the troubled product business in the medium term. Now, with a healthy cash conversion, the payout was handsome and the stock now offers a decent dividend yield of 4%. With the momentum sustaining in tech spending, HCL Tech's service business is well positioned to ride the same, and therefore we recommend investors to add the stock gradually amid market volatility. Despite negligible 0.5% sequential growth in dollar terms and softer margins, the bottom line was aided by higher forex gains and tax reversals leading to a lower effective tax rate. HCL Tech's service business, which is close to 90% of its revenue, it grew by 5% sequentially in constant currency, the third consecutive quarter of over 5% growth aided both by IT and business services as well as engineering and R&D services. The sequential 24% constant currency decline in product and platform pulled down the overall revenue growth. As against the earlier guidance of a flat performance of products and platform business, it actually degrew to the tune of 1.3% in constant currency, resulting in overall growth for FY22 at 12.7%, masking the very strong 14.9% growth in services. For the year, all three geographies, Americas, Europe, and the rest of the world grew in double digits, and the industry vertical performance was led by life sciences, telecom, media and technology services. Management has guided a revenue growth of 12 to 14% in constant currency for FY23. Supply-side pressures leading to higher compensation, aggressive hiring, training as well as subcontracting exerted pressure on margins, which declined 109 basis points sequentially to 18% in Q4 FY22. For the year, EBIT margins declined 258 basis points, coming in at 18.9%, of which 100 basis points were on account of investment. It's interesting to note that in Q4, service margins actually improved sequentially by 85 basis points on reversal of seasonal leave of Q3 and other operational improvement, whereas product margins declined on lower volumes, pulling down the overall margins. With the exit quarter's margin in the vicinity of 18%, the company expects FY23 margins to hover in the range of 18 to 20%. The deal pipeline is stronger than what it was at the end of December 21 quarter. For FY22, total contract value of new deals was at $8,308 million, registering a 14% YOY growth, whereas annual contract value was higher by 21% YOY on a full-year basis. In Q4, TCV of new deal wins stood at $2,260 million, a 6% sequential growth. HCL also won 10 large deals in Q4, and management expects strong order booking in Q1 as well. Client matrix remains healthy, with the company seeing one net addition each in $100 million and $50 million bucket and 8 in the $20 million bucket in Q4, along with several others in lower buckets. The strong demand outlook is backed up by supply readiness as the company continues to battle severe talent shortage faced by the entire industry. While attrition on LTM basis inched up sequentially from 19.8% to 21.9% in Q4, net addition remained good. For the year, net headcount addition was 39,900 with 23,000 entry-level hirings. Product business was a clear drag in FY22, and management believes, albeit its ability to give the company access to a larger clientele that can be leveraged by services, it should be viewed as a software startup with same volatility and unpredictability. However, a new management structure is in place, product rationalization is on, and there is a conscious effort to increase subscription-based revenue by changing the business model from premises to cloud-based or SaaS-based model. We see this as a long journey which is unlikely to deliver any magic in the near term. HCL Tech's shares, meanwhile, have underperformed both Nifty and the IT index in the past 3 months. With strong cash flow generation and no plans for big acquisitions, the dividend payout was healthy. The stock remains one of the cheapest large-cap IT stocks and could be therefore added gradually in a volatile market.